This presentation is for Chapter 5, Part 2, the analysis of financial statements. Leverage ratios are used to measure the extent of the firm's financing with debt. The amount and proportion of debt in a company's capital structure is extremely important to the financial analyst because of the trade-off between risk and return. Use of debt involves risk because debt carries a fixed commitment in the form of interest charges and principal repayment. Failure to satisfy the fixed charges associated with debt will ultimately result in bankruptcy. The leverage ratios include debt, long-term debt to total capitalization, debt to equity, times interest earned, cash interest coverage, fixed charge coverage, and cash flow adequacy. The debt ratio considers the proportion of all assets that are financed with debt. For Sage Inc., we see that the debt ratio increased in 2016 to 51.8%, indicating that a little over half of the assets owned by Sage Inc. were financed with debt. The long-term debt to total capitalization ratio measures the extent to which the long-term debt is used in the firm's permanent financing, including both long-term debt and equity. For Sage Inc., the long-term debt to total capitalization increased only slightly from 2015 to 2016. The debt-to-equity ratio measures the riskiness of the firm's capital structure in terms of the relationship between the funds supplied by creditors, debt, and investors' equity. The higher the proportion of debt, the greater the degree of risk because creditors must be satisfied before owners in the event of bankruptcy. The equity provides, in effect, a cushion or protection for the suppliers of debt. Sage Inc.'s debt-to-equity ratio increased slightly from 2015 to 2016, indicating a slightly riskier capital structure. Times interest earned indicates the ease of making interest payments on debt as they come due. The higher the ratio, the better. But this ratio can be misleading because it is based on net earnings instead of cash flows. For Sage Inc., the times interest earned ratio increased from 5.2 to 7.4, indicating that earnings is easily covering interest payments on debt. Perhaps a better measure of the ease in covering interest payments is the cash interest coverage ratio, which is determined by adding cash flows from operations to interest and taxes paid and dividing by interest paid. Sage Inc.'s cash interest coverage for 2016 was close to the times interest earned at 7.77, but the same was not true for 2015. Because cash flows were negative in 2015, the company only had interest paid covered 1.24 times this year. Fixed charge coverage is a broader coverage measure than times interest earned because it includes other fixed payments besides interest, like rent expense associated with leases. It is important to calculate because many firms extensively use operating leases that involve fixed payments. For Sage Inc., the fixed charge coverage ratios were much lower than times interest earned due to the rent expense associated with leases. Cash flow adequacy is often used by credit rating agencies to evaluate how well a company can cover annual payments of items such as debt, capital expenditures, and dividends from operating cash flows. Cash flow adequacy is defined differently by analysts, so it is important to understand what is actually being measured. Companies over the long run should be generating enough cash flow from operations to cover the investing and financing activities of the firm. Sage Inc.'s cash flow adequacy increased from a negative to a positive amount in 2016 since cash flows from operations returned to a positive amount in 2016. Profitability ratios are used to measure the overall performance of the firm as well as the efficiency of managing the assets, liabilities, and equity of the firm. The profitability ratios include gross profit, operating profit, net profit, and cash flow margins, as well as return on total assets. return on equity, and cash return on assets. Gross profit margin shows the relationship between sales and the cost of products sold. It measures the ability of a company both to control the cost of inventories or manufacturing of products and or the ability to pass along price increases through sales to customers. For Sage Inc., the gross profit margins increased slightly from 2015 to 2016, indicating the firm was successful in controlling the cost of inventory or was able to pass along any price increases to customers. Operating profit margin represents a measure of overall operating efficiency since it incorporates all of the expenses associated with ordinary business activities. For Sage Inc., the operating profit margin improved from 7.7% to 8.9% from 2015 to 2016, indicating management's success in controlling cost of operations while increasing sales over this period. The net profit margin is the last measure of profitability after consideration of all revenue and expense items, including interest, taxes, and non-operating items. There was a slight increase in the net profit margin for Sage Inc. from 2015 to 2016, but it will be necessary to look at the ratios over a longer time in conjunction with other parts of the analysis. Another important perspective on operating performance is the relationship between cash generated from operations and sales. Cash, not accrual measured earnings, is needed to service debt, pay dividends, and invest in new capital assets. The cash flow margin measures the ability of the firm to translate sales into cash. For Sage Inc., the cash flow margin greatly improved from 2015 to 2016 as the company returned to positive cash flows from operations. This was a solid improvement over 2015. Return on assets, ROA, or return on investment, ROI, indicates the amount of profit earned relative to the level of investment in total assets. It measures the efficiency of the firm in managing its assets. For Sage Inc., the return on assets improved from 2015 to 2016, indicating there was increased efficiency by management in operations. Return on equity measures the return to common shareholders, and this ratio is also calculated as return on common equity if the firm has preferred stock outstanding. For Sage Inc., there again was solid improvement in return on equity from 2015 to 2016, indicating that the company has been able to generate more earnings in relation to stockholders' investment in the firm. The returns on equity, 15.6% and 20.5% in both 2015 and 2016, respectively, were greater than the returns on assets, 7.8% and 9.9%, indicating that the company was successful in using leverage to increase the return on equity to the shareholders. The cash return on assets offers a useful comparison to return on investment. Again, the relationship between cash generated from operations and an accrual-based number allows the analyst to measure the firm's cash-generating ability of assets. Cash will be required for future investments. Sage Inc. increased greatly the cash return on assets when it returned to positive cash flows from operations in 2016 compared to negative cash flows in 2015. A discussion of market ratios is necessary because the reporting of these numbers does have a significant impact on stock price changes in the marketplace. However, it is important to remember that a thorough analysis of the company, its environment, and its financial information offers a much better gauge of the future prospects of the company than looking exclusively at earnings per share and price to earnings ratios. The four market ratios that will be discussed are earnings per common share, price to earnings or PE ratio, dividend payout ratio, and dividend yield. Earnings per common share is net income for the period divided by the weighted average number of common shares outstanding. The earnings per share ratio provides the investor with a common denominator to gauge investment returns. Earnings per share must be disclosed on the face of the income statement for publicly held companies. Sage Inc. increased earnings per share for 2016 well above the amounts reported for both 2014 and 2016. The price to earnings ratio, PE ratio, relates earnings per common share to the market prices at which the stock trades, expressing the multiple that the stock market places on a firm's earnings. The PE ratio is the function of a myriad of factors, which include the quality of earnings, future earnings potential, and the performance history of the company. The PE ratio for Sage Inc. decreased from 2014 to 2015, but improved in 2016. The ratio did not increase to the 2014 level, perhaps due to the decrease in 2016 dividend payments or cautious reaction to the improved 2016 year results. The dividend payout ratio is calculated by dividing the dividends per share by the earnings per share as a measure of the amount of earnings being returned to the common shareholders. Sage Inc.'s dividend payout ratio decreased in 2016 as a result of the new dividend policy announced by management to lower dividends to increase the availability of internal funds for expansion. The dividend yield shows the relationship between cash dividends and market price. Sage Inc.'s dividend yield was lower in 2016, again due to the decrease in the dividends per share as previously discussed. This diagram shows the key financial ratios discussed in relation to the areas of liquidity, leverage, operating efficiency, profitability, and market measures. There are 5 broad areas that typically constitute a fundamental analysis of financial statements, and these are the background of the firm, industry, economy, and outlook, short-term liquidity, operating efficiency, capital structure, and long-term solvency, and profitability. From this general approach, each analytical situation can be tailored to meet specific user objectives. The steps in a financial statement analysis should begin with establishing the objectives of the analysis. Next, researching the industry and industry climate of the firm in relation to current and projected economic developments is necessary. Developing a knowledge of the firm itself and the quality of the management aids in interpreting and evaluating the financial statement results in lieu of the strategies and goals that management has set for the firm. Last, a summary of the findings based on the analysis is made, as well as conclusions about the firm relevant to the established objectives. Companies don't operate in a vacuum, so the economic developments as well as the actions of competitors affect the ability of any business enterprise to perform successfully. It is therefore necessary to preface the analysis of a firm's financial statements with an analysis of the environment in which the firm conducts business. This involves blending hard facts with guesses and estimates. For Sage Inc., the outlook for the sporting goods industry is promising following a recessionary 2015. Americans are realizing the need to be active, and the 25 to 44 age group is projected to be the largest and most active group in the U.S. in the next decade. The 2 other major competitors in the sporting goods market operate in other geographic regions from Sage, giving it a competitive edge in the southwestern United States where it operates. Short-term liquidity is especially important to creditors, suppliers, management, and others who are concerned with the ability of a firm to meet near-term demands for cash. The evaluation of Sage Inc.'s short-term liquidity, as was calculated, shows that inventories have increased relative to cash and cash equivalents, and there has been an increase in the proportion of debt, both short-term and long-term. These developments were traced to the new store openings. With the increase in operating cash flows in 2016, there does not seem to be any immediate problems with the company's liquidity position at the current time. The timing of further expansion of retail outlets will be of critical importance to the ongoing success of the firm. The turnover ratios measure the operating efficiency of the firm. The efficiency in managing the company's accounts receivable, inventory, and accounts payable were calculated for Sage Inc. The fixed asset turnover has decreased over the past 5 years and is below the industry average, but this is to be expected given the increase in fixed assets for the home office and recent store expansion. It should improve if the expansion is successful. The analytical process for capital structure and long-term solvency includes an evaluation of the amount and proportion of debt in a firm's capital structure, as well as the ability to service debt. Debt implies risk because debt involves the satisfaction of fixed financial obligations. The major advantage of debt is that when it is used successfully, it magnifies shareholder returns. The ratios for Sage Inc. indicated a steady increase in the use of borrowed funds. Sage increased its investment in capital assets, particularly in 2016, when additions accounted for 82% of total cash outflows. These investments were financed largely by borrowing due to sluggish operating performance in 2015. Operations supplied 73% of the cash in 2014 and 62% in 2016. The impact of the borrowing is seen in the firm's debt ratios. To measure the effectiveness of the use of financial leverage, the financial leverage index can be calculated by dividing the return on equity by the adjusted return on assets. The adjusted return on assets includes net earnings and interest expense multiplied by 1 minus the tax rate divided by total assets. When the FLI is greater than 1, the return on equity exceeds the return on assets, indicating that the firm is employing debt beneficially for the shareholders. Sage Inc. had a financial leverage index of 1.8 in 2016, up from 1.6 in 2015 and the same as in 2014. This indicates a successful use of leverage for the 3-year period when borrowing increased. The profitability analysis determines how well the firm has performed. For Sage Inc., the gross profit, operating profit, and net profit margins all increased from 2015 to 2016. This was positive given that there were new stores being opened that featured many sales of discounted products to customers. The operating profit increase in a time of expansion indicates careful management of operating expenses, especially lease payments as new stores opened. The net profit also improved in spite of the increased interest and tax expense and a reduction in interest revenue from cash equivalents. After declining steadily through 2015, the return on assets and cash return on assets increased strongly in 2016. It would appear that Sage is well positioned for future growth. It will be important to monitor the firm's management of inventories, which accounts for about half of its assets and has been problematic in the past. Having looked at the individual ratios as well as groups of financial ratios measuring the different areas of liquidity, operating efficiency, capital structure, and long-term solvency and profitability, it is helpful to complete the evaluation of a firm by considering the interrelationship among the individual ratios. The DuPont system helps the analyst to see how the firm's decisions and activities over the course of an accounting period interact to produce the overall return to the firm's shareholders, the return on equity. By reviewing the series of relationships, the analyst can identify strengths and weaknesses as well as trace potential causes of any problems in the overall financial condition and performance of the firm. In the first three ratios revealed that the return on investment, profit generated from the overall investment in assets, is a product of the net profit margin, which is profit generated from sales, and the total asset turnover, or the firm's ability to produce sales from its assets. Extending the analysis, the remaining 3 ratios show how the return on equity, or the overall return to shareholders, the firm's owners, is derived from the product of the return on investment and financial leverage, or the proportion of debt in the capital structure. Using this system, the analyst can evaluate changes in the firm's condition and performance, whether they are indicative of improvement or deterioration or some combination. This allows the analyst to focus on specific areas contributing to the changes. Evaluating Sage Inc. using the DuPont system over the 5-year period from 2012 to 2016 shows the following relationships. The return on equity is below earlier year levels, but has improved since its low point in 2015. The system provides clues as to why these changes have occurred. Both the profit margin and the asset turnover are lower in 2016 than in 2012 and 2013. The combination of increased debt, financial leverage, and the improvement in profitability and asset utilization has produced an improved overall return in 2016 in relation to the 2 previous years. Specifically, the firm has added debt to finance capital asset expansion and has used its debt effectively. The firm's ability to control operating costs while increasing sales expansion has improved the net profit margin. The overall return on investment is now improving as a result of these combined factors. Some additional analytical tools and financial ratios are relevant to financial statement analysis, particularly for investment decisions and long-range planning. Earnings forecast and pro forma financial statements are 2 such tools. It is important not to confuse pro forma financial statement prepared by companies based on non-GAAP measures with pro forma financial statements prepared for financial statement analysis. Pro forma financial statements prepared for financial statement analysis are projections of GAAP-based financial statements based on a set of assumptions regarding future revenues, expense, level of investment in assets, financing methods and cost, and working capital management. These are used primarily for long-range planning and long-term credit decisions. The analysis of any firm's financial statements consists of a mixture of steps and pieces that interrelate and affect each other. No one part of the analysis should be interpreted in isolation. Every aspect of a firm's financial condition, performance, and outlook affects the share price. The last step of financial statement analysis is to integrate the separate pieces into a whole, leading to conclusions about the business enterprise. The specific conclusions drawn will be affected by the original objectives established at the initiation of the analytical process. The FASB requires companies to disclose supplementary financial data for each reportable segment, including foreign operations, sales to major customers, and information for enterprises that have only one reportable segment. Segmental disclosures are valuable to the financial analyst in identifying areas of strengths and weakness within a company, proportionate contribution to revenue and profit by each division, the relationship between capital expenditures and rates of return for operating areas, and segments that should be de-emphasized or eliminated. The information on segments is presented as a supplementary section in the notes to the financial statements as a part of the basic financial statements or in a separate schedule that is referenced to and incorporated into the financial statements. Analytical tools that are used to assess segmental data include percentage contribution to revenue and operating profit margin, capital expenditures, return on investment, and an assessment of the relationship between the size of a division and its relative contribution. For each reportable segment, the FASB requires that general information be provided, as well as information on each segment's profit or loss and assets. When reviewing the segment information provided for Sage Inc., we noted that the sporting gear and equipment line provides the greatest percentage of revenue, but the sporting apparel line provides the greatest contribution to operating profit. The company increased the capital expenditures in both of these areas, which led to increased profits. The footwear line is the least profitable, and the company decreased its investment in this line appropriately in 2016. This is the end of the presentation for Chapter 5, Part 2, the analysis of financial statements.